Hello and welcome to this week's Midweek Market Show, the show where I talk about what's going on in investment markets and what to look out for in the future. Now, this week we've had the markets dip slightly and then rebound, and we're now pushing much higher again, so it's actually a slightly bullish setup. If I had to use a term to describe the markets right now, it would be probably a mess, to be quite frank. What we've had is the markets pulled back. So we look at the S&P 500 on your stock app. We had it pull back last week as markets got a little bit nervous about the global growth, and then they rallied. And they rallied because there were some great numbers out of China in terms of manufacturing, some PMI data, basically good news for the global economy. So people were thinking that perhaps there would be a soft landing for the Chinese economy, which is the second biggest economy in the world, and the economy would rebound. So some of that liquidity, that pumping of money that the central bank in China has been doing, and the new legislation that the Chinese government has been putting into place has actually started to take effect, in which case that would be good news. So the stock market rallied. In fact, this week we saw the Chinese stock market continue its meteoric rise that it's had this year, when it actually jumped about 3% in a single day. Now that sort of euphoria bled over into the rest of the world. We saw the US stock market pick up. There was some sort of slightly positive news from America, although markets seem to be now in that zone, that Goldilocks zone, where any bad news is seen as good news because the central banks would hopefully therefore keep boosting liquidity, maybe cut interest rates. Actually, the odds of a rate cut by the US Federal Reserve, or the Bank of England for that matter, have increased. So they're hoping that they're going to keep pumping the stock market and asset prices higher. So we're in that strange Goldilocks scenario where bad news is good news. So with the S&P 500 in particular, we are now way above that 2800 to 2825 level. We're back above that, and we're now pushing to 2860 and beyond. And that is actually above any high that we've had this year. And we're going back to levels that were last seen during the sell-off in October 2018. So that's quite bullish. The other bullish thing that's happened is we've had a golden cross. Now, a golden cross is where the 50-day moving average, so the average price over the last 50 days, if you track that as a line, that's actually crossed above the 200-day moving average on the S&P 500. Now, that is seen as a bullish sign by long-term traders, and it can encourage them to start entering the market again, because there's been a lot of people sitting on the sidelines. So the bulls are actually thinking that this is going to give more fuel to the rally, which is just as well really, because the buybacks that go on, if you don't know what a buyback is, don't worry, we'll come back to it in a future episode, but they've been helping push the market higher as well. So people are hoping that the long-term traders may start entering the market, and it'll give us more fuel to head towards 2,900. So if you look at your charts, what you're looking at now is 2,900 is our next level on the S&P 500, which would be a level that's going to be very difficult to break above, because there's been lots of selling pressure there in the past. If we get above that, we can go looking at new all-time highs. Now, it's not a given that it will happen. There's lots of negative stuff out there. If we look at the market as a whole, as an index, like I said, it's a bit of a mess. But if we look at the individual sector levels, then certain sectors are doing well, others aren't. And as an index, which is obviously a combination of all those individual sectors within a market, it's unlikely to hit an all-time high unless all those sectors are starting to hit all-time highs. And that's not happening. At the moment, we're getting areas within the US stock market that are doing well. We're getting the REITs that we've talked about, so the real estate investment trusts, which invest in property and get income from rentals. They're doing well because they're kind of seen as quasi-bond investments. Now, they've been doing well. We've had energy doing very well because of the oil price that's been rallying. We've had financials, though, doing very badly. Now, that is because when interest rates look like they're not going to rise, that puts pressure on banks' profit lines. So we've had areas of the stock market, certain sectors do well, but there are many others that aren't doing well, and they're not hitting new all-time highs. So unless they all do, it makes the chances of an all-time high on the index level less likely. So we've got some bullish setup. We've got a golden cross. We've got some money coming into the market. We're above key resistance levels on the S&P 500, but there's still a bit of a mess going on. So looking at other stock markets around the world, in the UK, the FTSE 100 has risen. You may remember from a previous show, I said, look, if we get above 7,250 is quite a bullish sign. We end up normally closing the gap towards 7,500 relatively quickly. And even though we had a bit of a dip during the week, we've now suddenly rallied and we're looking at 7,400 already on the FTSE 100. That doesn't mean we're going necessarily higher. We're definitely going to get there because there is another mess. It's not just the general makeup of the stock market. There's another mess that's going on, which is Brexit. Now, I won't get into the nuances of Brexit, but as you know, we seem to veer from complete chaos to utter chaos. And the only thing that tends to do is it tends to mean the value of the pound fluctuates. And in the last week, the value of the pound plummeted and it dropped below the 130 level. 130 against the dollar is a key level. We dropped below that before getting back above it. And when the pound falls, that's rocket fuel for the FTSE 100. So that's one of the reasons why the FTSE's been rallying, and also the oil price. There's a lot of oil stocks in the FTSE 100. So we've got a bit of a mess with Brexit. We don't know what's going on. The market, if you listen to some analysts, they're actually underpricing the chance of a no-deal Brexit, that we crash out. Now, it's hard to say exactly what's being priced in, but if we do crash out, everyone's thinking there's going to be some deal, or we're going to just keep bumbling on, or it'd be pushed off, kicked down the road like lots of things do in politics. If we don't, then keep an eye on what happens in the pound. There could be a lot of volatility. That means for us in the UK, it makes investing quite tricky. We're trying to make changes because the market and currency markets could move wildly for and against you. Now, looking across to, like I said, China, emerging markets, some of those have been showing quite a lot of strength. In China, the equity rally has been very good. So overall, equity bulls are very positive. The bears have taken a bit of a hit this week, but it doesn't mean there's a long way to go yet. With the bonds, a lot of the movements in equity markets can be attributed to what goes on in the bond market, because as the bond market goes up, so people buy bonds, then what's happening is equity markets are tending to fall. So keep an eye on that 10-year treasury yield on your stock market app. Its code is TNX. Have a look at that. It's almost, again, a bit of a quick indicator of what's going on. The VIX has been tumbling. We got above 15, that key level again, and we've now dropped back below it. So as we stand at the moment, bonds are still doing well, although they're having a little bit of a weak week this week, a lot of weeks there. But they're also, equity investors are now starting to feel a bit positive. But overall, the markets are getting a little bit messy. We always think the markets have to go up or they have to go down. There is the possibility that a market can just trundle sideways for an extended period of time. We could very well be in a market like that, trapped between different sort of resistance and support levels. So don't be surprised if in 2 months' time we're having a similar conversation as we are today. Now, if there's something you want to look out for in the next week, of course, we've got Brexit and what might happen with Brexit. But in America, we've got a jobs number that comes out on Friday. Now, that is always, a lot of attention is paid to that. And one of the reasons they're paying a lot of attention to it this week is because if wage growth suddenly picks up, then that could actually give an early indication of inflation coming back. Now, if wages go up, that means that people tend to spend more money in the shops, which pushes up prices, which is why we get inflation. If it becomes sustained, and by that I mean wage inflation becomes sustained, then that can give central banks a headache, because the way they combat that is to raise interest rates. Now, with the economy in the US and globally very weak, they don't want to raise interest rates. Like I said, the chances are we're going to see rate cuts at some point in the future. So if inflation starts to creep back in, that could cause a big problem. And if the conversation starts to change towards more rate hikes than rate cuts, or the market starts pricing that in, then that could cause a wobble in equity and bond markets. Now, that is it for this week on Midweek Markets. If you want to get in touch, then please do so at Damien at moneytothemessage.com. Of course, you can get me on Twitter at moneytothemessage with the number 2. So that is it. Until next week.